Okay, thank you very much for being here on time. We will try very hard to keep to the schedule and end at 4:30. And for this, I have begged all participants to keep their initial statements to 6 minutes, but I will have some nice cards to show when the time is over. If you read documents from international organizations, you will often find the sentence about uncertainty being very high. I mean, this is a recurrent theme. And it cannot be true every time because it cannot be exceptional so often. If it's so often, then it's not exceptional. But if there is one time when this statement is correct, I think this is now. I think that this sentence can be safely be used over these days. Economic activity, as we know, both in the United States and in Europe, has surprised in the second half of this year on the upside. But there are fears, and well-founded fears, I would say, that the scares of the pandemic will affect supply, if not demand, for the years to come. Inflation is higher than it has been in many years, exceptionally so in the United States, but also in Europe, as we saw from the latest figures. But central bankers, international institutions, most observers, maybe the share of observers in this camp is going down, but they think that this is transitory and that as the past of the pandemic will dissipate into the past, inflation will go down. We have in Europe the very big progress of the next generation EU, but there is, or at least I have, a lot of uncertainty about implementation. I mean, the idea is good, so far so good. We still have to see the test of the pudding. And of course, to further aggravate uncertainty, we don't really know how the pandemic is developing. We hope this is going fine. This gathering is a sign of hope, but we don't know. And last, I would say inequality. Inequality across countries, inequality across the sectors of society has increased. Against this background of uncertainty, I think we are very lucky to have quite a gathering of experts, speakers, and views. We have Minister Šircelj, Governor Vasle, EBRD President Renaud-Basso, the EIB Vice President Pavlova, the Managing Director of the SM Regling, Mr. De Luca, President of the Task Force Europe, Mr. Singer, Chief Economist of Generali, and Mr. Wolf, Deputy CEO of OTP. So without further ado, if you allow, I will start asking questions to the panelists, and I will again ask them to keep to the 6 minutes. And I would like to start with Minister Šircelj, asking him how he assesses the economic policy of the EU in combating the COVID-19 situation, and what are the national experiences in designing policies, fully exploiting the opportunity for a better tomorrow, as in the title of our panel. How do you see the future progress of the EU economic governance, Minister?
Well, thank you very much. Thank you very much. It works. Thank you. Thank you very much for this opportunity. Thank you very much also to the invitation, and let me stress some points of my view, how I see pandemic crisis, and also how I see the, let's say, challenges and opportunities which are in front of us. First of all, I would like to go very briefly 1 year and a half ago, and let's see what had happened at that time. So I think that Europe and also Slovenia were unprepared for pandemic crisis. At that time we didn't get vaccination, we didn't get enough beds in hospitals, etc., etc. And also our economy was not prepared for pandemic. But let me say that our reaction was very fast and very quick. And first of all, the whole Europe and also Slovenia, I think that the strategy objective was to secure jobs, to help economy with different measures on financial side and also on fiscal sides. And let me say on this way that comparing with, let's say, financial crisis in 2008, 2009, that time, in pandemic crisis, fiscal and monetary policy works hand in hand, and so we secure jobs and also reaction of monetary policy was a little bit different. On the other hand, of course, we've got macroeconomic results, let me say on this way. It means that debt increased in one way, and also deficit in all countries also increased. And of course, in general, that is not for the economy. But we've got vaccination, so we've got a medicine, and this is the most important thing. And the most important thing is also for economy that now we are open, and we have to do the best in medical sector to continue with this. Also here I would like to mention different countries, and vaccination ratio is different in all over the Europe, and of course I would like encourage these states which vaccination is not so good to encourage vaccination for the people. But let me go back to the economy, and I think that recovery and resilience plans which adopted European Commission, and which is now in implementation phase, is also a unique measure, which shows, let's say, also, let's say, some policies which happened the first time in Europe. It means that we started with sustainability finance in one way, and on the other way, in Europe, the first time we have, let's say, we have a new value. It means solidarity, and of course, it is good for Europe, and this is also good for all the countries. What is also very important, that in this recovery and resilience plans, we've got targets, so the targets are very clear. Green targets, digital targets, and reforms. And we have to do these reforms in all the countries. If I would like to mention Slovenia, I mean special reforms on health sector and reforms in pension sector. It is very important for us, and I think that each crisis, of course, has also some possibilities and opportunities, and I think that we could be at the end of this crisis, at the end of pandemic, stronger, more competitive, and also I think that also we can compare with other continents and other economies in our globe. Thank you.
Thank you very much. I would take one point you said that unlike during the financial crisis, monetary policy and fiscal policy worked in unison, worked together. And this was to a large extent possible because inflation was well behaved in the period. And the ECB recently reaffirmed this policy in the conviction that inflation will continue to be well behaved. What I would ask from Governor Vasle is how solid is these expectations? What are the variables that we should look at to see whether indeed this conviction, which is critical, is indeed prevailing into the future?
Good afternoon to everybody, and thank you very much for your question. Before I answer, allow me just a few words to thank the organizers, first of all, for preparing the panel with the economic topic, which is of course crucial when we are thinking and talking about the future of Europe, and of course for inviting me into this distinguished panel to present my views. Now, regarding your question, the fact is that the data we are receiving now on a daily basis is showing that our economies are on the path of a strong rebound. And this rebound is, of course, possible only because of different policy response we prepared during this crisis. First of all, it was a very fast response. It was well coordinated between monetary policy, fiscal policy, and also part of structural policies. And of course, it was a bold one. So, as for the monetary policy, our role was to provide an ample liquidity to all participants in the economy, meaning to the governments, to enable them to finance huge fiscal support, to the banking sector, which in turn provided liquidity to the companies and to the general public. So what we are seeing now is, at least in my opinion, an obvious sign that what we did was a correct step, and that we really avoided bad outcomes we witnessed during the previous crisis. Of course, there are still many risks regarding the health situation, and it's also, we must be honest, we still do not understand in full extent how the health crisis will translate into the real economy, what will be the long-lasting consequences. So that's why we still believe that our support measures are still essential, they're still needed, so we are not planning to remove them. As for, to go directly to your question now, as for the inflation, it's true that at the moment we are receiving data which are, inflation data which are higher and higher from month to month. Currently, inflation in euro area is running at 3%. Here in Slovenia, it's slightly lower, but still about 2%. But looking slightly deeper into the data, our baseline scenario, most probably outcome is that this is a temporary shock to prices, and that price growth will fade out and will return to closer to 2% or even below 2%. And why we do think that this will happen? Because the composition of current inflation is pretty much affected by one-off factors, by temporary factors. To give us just a few examples, one of them is what is happening to the fiscal policy. For example, fiscal measures, VAT increases in Germany, they were lowered during the pandemic, and now they returned to the previous level, and this of course is visible into the inflation figure. It is a significant impact, for example, 0.6% at the EU level. Then we do have we do have a contribution of energy prices, and again, we are talking about the base effect, namely energy prices went down at the beginning of the pandemic crisis, and now they are returning to more normal levels. But in terms of measuring inflation, this is recorded as an increase in inflation. And the third factor I would like to mention here are bottlenecks in the supply chains. And again, we do believe that this is not something which will stay with us. These are temporary factors. So putting all this together, our baseline still is that inflation will moderate throughout the year, by the end of the year, and that it will remain moderate in the medium period. However, we are not ignorant to the risks which are appearing or even getting stronger and stronger from quarter to quarter. And these risks are mainly related to the second round effects, or to put it more simply, to the labor market. At the moment, what is missing, of course, in positive terms, for inflation to become permanent are the pressures from the labor market. We are still living in a situation where the wage increases are missing. So this is the main element for our current belief that inflation will get lower in the next months. But of course, as I said, this is one of the biggest risks at the same time. If the pressures will start to build on the labor market, if we will witness some increases on wages, it might happen that inflation will become more permanent. And of course, at the moment we are monitoring carefully the situation in the whole euro area, in different aspects of our economies, and since we are data dependent, if the situation will change, if our expectations and also expectations of other agents in the economy will change, then we will align our policy. But at the moment, as I already said, and I would like to emphasize again, it's not the case, and we will remain our accommodative monetary policy for the next period. Thank you.
Thank you very much. Very useful. One sign of the increasing structural economic integration in Europe is the importance of international institutions. And we have, of course, here three critical institutions from this point of view. And I would start asking from the chair of the EBRD about a compositional aspect of the macroeconomic situation: inequality across countries, inequality within countries. The EBRD has stressed these points. And so how do you see the risk of a lopsided recovery? I mean, we have a lot of inequality already. That was further increased with COVID. If anything, we need to reduce it, and the risk is that it will further increase. So how do you see the situation, and what can the EBRD do, both across countries and across sectors?
So thank you very much for this question. Thank you very much also for the organizers for inviting me to participate to this event in an absolutely fabulous environment. But so on this question of inequalities, I will start by the across-country level, because indeed what we see with the crisis is that there is a big risk. I mean, when getting out of the crisis, of course the COVID crisis has touched all countries in different manners, but everybody has been touched. But in different manners, and the way out of the crisis may also be quite different. The first big difference is access to vaccine. And in a way, I think, I mean, when you look at the figures and the rate of people vaccinated across countries, there are a huge difference between Africa and developed countries, between emerging countries and more developed countries, from a few percent to 80%, 70, 80% of the population. And this, of course, will create, moving forward, huge risk in terms of economic divergence, because when your population is not vaccinated, the risk to have new lockdown measures, new restrictive measures with a very heavy weight on the economy is much larger. And we can see how difficult it is to manage at the global level this issue of vaccine, because of course governments that have the means, and Europe, for example, that has the means to buy vaccine for the population, needs to address the need of its population. But and solidarity can play a role, but it's very difficult to be up to the needs in terms of, for example, the implementation of the COVAX facility. Some countries are financing, there are some distribution of vaccine, but compared with the need, it remains very, very far. The second source of inequalities across countries is inequalities in the room for maneuver in terms of fiscal and monetary policy. Developed countries have been able to increase the fiscal deficit much more rapidly and much more than some emerging countries that had more constrained on market access, capacity to increase the debt, and so forth. And some countries are also, and we are listening about inflation risk, some countries are facing much higher inflation risk. For example, when you look at the situation in Turkey, with double-digit inflation for a long period, this is a much higher risk than in other areas. So that's the question of the margin of maneuver, also getting out of the crisis, the capacity to continue to support, for example, to keep fiscal support is very different across countries. Some countries were able to support their companies and SMEs, for example, in the first wave, first containment measures, but needed to get out quite quickly because of their debt level and so forth. And we see the cost of increase of cost of financing in some countries increasing quite substantially. Often it's not only due to economic factors, but also political. For example, you see the situation in Tunisia, in Belarus, I'm not talking about Lebanon, but countries like Montenegro also more under pressure in terms of cost of financing. The third inequality is about the structure of the economy. The impact of COVID, which was a very specific shock, differs very much depending on the economy. If you are a service economy or a country with high dependence on tourism, you are much more affected than if you are manufacturing. Manufacturing activity has rebounded much more quickly. Now I think is less risky. We can see even this summer tourism remain quite weak and subject to further risk, and services basically have been more touched. So we can see also the economic impact on very different depending on the structure of the economy, and this will remain with us. In this respect, I think that the European country situation has been quite favorable because of the solidarity aspect, which is, for countries weaker with higher dependence on tourism, for example, the impact on GDP has been higher, and then the solidarity package has kicked in with higher figures. So this has been extremely helpful, and not to mention also the solidarity on vaccine with a mechanism that took a bit of time, but then worked very well, I think, and provided a sort of safe, a common approach and common access to vaccine. So this was for the across country, but looking forward in terms of for a multilateral institution like EBRD, it's a bit of a challenge, and I know this is a big concern also for the IMF and so forth, because also in the phase of when we will go into the phasing out of the for example, of the monetary stimulus, the impact of the phasing out can be quite different across countries, and some emerging countries, for example, may have more difficulties access to financing, access to foreign investment in relation with US tapering. If we look at inside country inequalities, this will become also a big issue, because the COVID situation has increased inequalities, and you see its impact is probably higher in emerging countries. We made a survey showing that in emerging countries, 3/4 of people had the impression, had direct impact of the COVID crisis on their way of life and so forth, their condition, which was only half in more developed countries. So you can see that this issue of inequalities in the countries will become, is a big issue. In particular, this is also true for gender. Women have been more particularly affected, maybe because they work more in services, they are doing more of the family work, and when children were not at school, they had to bear more of the task of that. And so this is also something we try to address. So as EBRD, just one word, what we can do, we are really focusing our support to accompany the country in the response to the COVID crisis and supporting in particular private sector financing, because one of the outcome of the crisis is higher public debt level. So I think that managing to support the private sector and using some of the savings to finance the rebound of the activity will be very important in the coming months. And the second priority is really to address this inequality. This is we will have a strategy on that, and in each and every project we try to bring this dimension. This goes hand in hand with two key structural priorities that all economies will face, which is the green challenge and the climate challenge. And this summer, I think that the awareness must have increased in view of what happened in a number of countries. And the second one is digitalization, which will be also an area where we focus a lot, and it will help fighting inequalities in different ways. But I can come back to that later.
Well, thank you very much, and thank you for not having blatantly corrected me, because I said, oh, there are inequalities across countries, or there are inequalities within countries. You told us there is a crossing of inequalities. I mean, there are some sectors in some countries that are particularly hit. So it's not only the two, but also the mix between, or the joint effect of the two that is worrying. I would now move to the EIB, and the EIB, as I said, is having a growing role in the EU economy and beyond, because it's not only in the EU. And I think that the EIB is particularly engaged in the Green Deal. Of course, this is something that is touching everybody. Everybody is contributing to that, but that applies to the EIB with special force. And I think that a sustainable economy is an important part of the better tomorrow, which is announced in our panel. And so from the Vice President of the EIB, Mrs. Pavlova, we can learn how the EIB is adapting its investment to contribute to the Green Deal.
Thank you very much, Francesco. Dear ladies and gentlemen, first of all, I also want to join in thanking and congratulating our organizer for this excellent opportunity to discuss this really important, critical topic today in these exceptional times in which we are all living, and the gravity of the COVID pandemic is still unfolding, and all the steps which we are undertaking now and which we are planning for the future to caution the health and economic fallout, they have all to be very, very well, very precisely planned and coordinated. And because we really need to be decisive about the principles that will guide us, that are guiding us every day in our decisions, in the planning on how to support the recovery, speaking about green digital recovery, because we are on the right path now to use this crisis also not only as an opportunity, but also as in a way to rethink, to analyze the lessons learned and to rethink how we build a better future. As you mentioned, inequality is important, and from this perspective, of course, this is really important while we are planning the economic measures together with the other crisis, the climate crisis, that the transition is fair and it's just. And one very important element in the transformation of our economies, of the health systems, of addressing the climate change, is really that we need to invest heavily in new technologies, in skills and education, and in infrastructure. I believe these are the three key elements of the investments on which we need to emphasize. And from this perspective, EU and all EU institutions, together with the multilateral development institutions, we should all play and have a joint effort and really play a role in mobilizing the necessary resources, but at the same time making sure that we are attracting or crowding in also the private sector investments in the future. But few words about green transition and the role of the European Investment Bank being the EU climate bank. At the same time, I should say that like all the EU institutions and multilateral financial institutions, but EIB since 2012, almost 10 years, we've been investing almost 200 billions of euro in supporting climate action, environmental sustainability projects, and many others. Only last year, 40% of our lending was dedicated to climate and sustainable financing. And annual financing we are providing is approximately 70 billion euro. So 40% is a significant amount of investments we are already providing for green and sustainable development. In our transformation into a full climate bank, last year our board unanimously, 27 member states, approved our climate bank roadmap, where we present our short-term and long-term vision on how we will be supporting the European Green Deal and the climate change adaptation. The key elements of our climate bank roadmap are, first of all, what we are planning is to mobilize additional 1 trillion of euro of financing till the end of the decade, till 2030, in support in financing climate and environmental sustainability. Second element of our climate bank roadmap is that we are planning by 2050 to reach minimum 50% of our, today we are at 40, but to reach minimum 50% of our lending to be dedicated in support of this transformation, green and digital transformation, but specifically on climate and sustainability. What is important that all our investments from this year, we adapt our rules and procedures should be Paris aligned. We are the first multilateral development institution which is fully Paris aligned with the goals and the principles of the Paris Agreement. And last but not least, of course, we are adapting all the different mechanisms and supporting the EU preparing the taxonomy, sustainable development and sustainable financing taxonomy, together with the draft EU bond standard. This is another important element. In last minute, being inventor of the so-called green bonds already in 2007, as of today, we have achieved and we have supplied more than 33 billion euros of climate awareness bonds. We recently pioneered as well sustainability awareness bonds. So what we are now focusing is on providing more flexibility and extending our eligibilities of the green bonds, as we call, in order to provide opportunities for investments in climate adaptation, which with the flooding, with the different consequences of the climate change which we are all facing, are really important investments. I will stop here because we don't have much time. Only one element. In conclusion, now we have plenty of funds. We support very much the Next Generation EU and the main pillar, the Recovery and Resilience package. So the funding is available. I should say we do have available a huge amount of funds. Which is the European funding, together with EIB, EBRD, and all financial institutions. But now the volume is not the only important element. The other important element is the quality of the projects and the long-term vision to ensure that these projects are sustainable for the future to address the goals and the needs. So what we can offer on the top of what I was saying is our in-house advisory support, technical and financial advisory. What we are proud of that we have in the bank strong teams of engineers, economists, and the different fields which could really provide the necessary support to build a strong pipeline of projects in order to be implemented as in the long-term vision of a sustainable investments. Thank you.
Well, thank you very much, Mrs. Pavlova. What I would notice in your, you referred to just and fair transition to green. And of course, this is very much having to do with inequality. So in the two interventions, there is quite an emphasis on this aspect. Now, from Klaus Regling, the ESM Managing Director, we can ask, what does what we have heard so far mean for the international role of the euro? I mean, we know that this has become, since maybe the last 2 years, a policy a priority of the European Union. So what we would like to hear is what this means for the international role of the euro, and immediately connected, what is your assessment of capital market union? I mean, we have been working about capital market union for 7 years, and we keep saying that it's very important to do it, which means we haven't done it in 7 years. So what is your assessment of this important initiative, and what is the link of this initiative with the post-epidemic recovery, and of course, what can be the role of the ESM in all this?
Yes, thank you very much, Francesco. It's a pleasure to be here in Bled and to see so many familiar faces again after all this time. So indeed, I want to speak about the monetary union, because previous speaker mainly took the perspective of the European Union, except the governor, of course, because the ECB's role is to control the monetary unions. ESM is also an institution of the euro area. Of course, looking at the future of monetary union and the future of EU, there are very close links. The two are connected, of course. What is good for the monetary union is normally also good for the EU, and vice versa. The latest example is Europe's policy response to the pandemic. We heard about that. It was fast, powerful, and well calibrated, as the minister emphasized. And all the policy measures were well coordinated at national, institutional, and EU level. This helped the EU single market, so it really helped the EU as a whole, but it also helped the good functioning of monetary union. So a clear link here. Going forward, the EU needs to transform its economies to slow down climate change. I think everybody talks about that here, everybody agrees. And to remain competitive, also we have to work on digitalization. But in addition to all those good objectives, the monetary union has additional challenges that need to be addressed. Monetary union, EMU, has shown itself capable of institutional innovations over the last 12 years since the euro crisis. With the euro crisis, we adapted the institutional architecture of EMU. We set up a host of new institutions that increase the effectiveness of crisis prevention and crisis management. And I'm referring here to the Single Supervisory Mechanism, the SSM, the Single Resolution Board, but also the ESM, European Stability Mechanism, the institution that I manage. Together, the creation of these new institutions, and some of them would have been unthinkable before the euro crisis, represented an institutional leap forward. But more needs to be done to make monetary union more resilient. The issues that need to be tackled are well identified and have been on the agenda of our meetings, the Eurogroup, the Council of Ministers, the agenda of the European Commission, for some time. As also Francesco mentioned, banking union, a single market for financial services, a capital markets union, all this does not exist today. But if we had it, it would contribute to stronger growth in Europe by allocating capital more efficiently across countries, and it would be good for the entire European Union. A fully integrated financial market would also dampen cyclical divergences among member states of the euro area. And here I come to the special challenges that the euro area faces. This is something the EU doesn't face, but only the euro area. Economists call this risk sharing, and that is very much underdeveloped in the euro area compared, for instance, to the United States. Difficult decisions need to be taken to complete the banking union, including the famous common deposit insurance. The next important step is the ESM's backstop for the Single Resolution Fund. It will or should become operational early next year, so that's one next step for completing banking union. And capital markets union is the other big project to strengthen risk sharing inside the monetary union. Right now, the euro area consists of 19 different capital markets along national borders with their own rules and barriers to cross-border investment. Our monetary union would become much more robust with a full banking union and capital markets union. Risk sharing would become much more substantial, like in the United States, where the integrated financial market and capital market ensures that cyclical divergences do not become excessive. But risk sharing can also take place via public channels. Today, this happens a little bit via the EU budget, via EIB lending, through the financial support that the ESM provided in the last decade, and more recently through the Next Generation EU program that will unfold over the next few years. However, the EU's pandemic crisis tools, SURE and Next Generation EU, are temporary in nature, and they are tailored to the needs of all EU member states. For the euro area, there are other important options how to share risks. It would be useful to complement the toolbox of monetary union with an additional macroeconomic stabilization instrument. Member states of our monetary union need more fiscal buffers from time to time than countries that have their own national central bank. Because without their own currency, fiscal measures are the only macroeconomic instrument to respond to an external shock, like a pandemic. Such a fiscal stabilization instrument would not need to provide additional transfers. It could be a revolving fund, for example. Finally, and importantly, all the efforts to complete monetary union that I mentioned would also strengthen the international role of the euro. The significant increase in euro safe assets as a result of the recent actions to fight the pandemic, together with completing banking union and progress towards capital market union, will improve the depth and liquidity of euro area financial markets. This, together with the fiscal stabilization instrument, would make the euro more attractive for international investors, hence strengthen its international role. Thank you.
Thank you very much, Klaus. While you were talking, I was thinking of how I console myself when I have to climb some mountains. I look back and say, oh, well, we have gone a long way. And then I look in front and say, oh, we still have a long way to go. And I mean, your speech was, yes, we have done a lot, but it remains a lot to be done. Yeah, that's the construction, the beauty of Europe in a way. I mean, it would be a dead enterprise if we had done everything. So thank you very much. I think we are moving to more specific but critical issues with the last three speakers that can help us drill down on more specific issues. The first one I would address to Mr. De Luca, who is the board president of the task force Italia. And I would just notice that the economic situation in Italy, the economic development in Italy has been very disappointing over the last quarter century. So it's a long-term affair. It used to be fifth in Europe in terms of GDP per head, and it's now 11th. And this has had serious social consequences. And I think that a widespread view is that this has been due essentially to unfavorable structural conditions. Now, the EU Recovery and Resilience Facility provides funds to Italy, but also asks changes, also asks reforms. What I would ask from you, and I think everybody would be interested in your answer, is what is the importance of the funds and what is the importance of the structural changes? I mean, how much do we have to put the weight on one or the other? And then, maybe a bit more speculative, what is your view about the prospect of success of the Italian usage of the facility?
Thank you, Francesco, for your questions. Let me express my gratitude to the organizer for inviting me again this year. And I'm really honored to be part of the debate with such distinguished panelists. I'm representing Task Force Italy, that is a selected and independent group of high-level experts and managers that support governments and the private sector in relaunching economies and social inclusion. And let me start to put on the table a difference between the past financial crisis and the pandemic, COVID-19 pandemic. The first one, all the measures were applied with conditionality because we need to correct the mistake by policy actions and the macroeconomic imbalances that were eating our economics and to fragment our single market. Nowadays, the characteristic of this crisis is that governments are not responsible for what happened. So it means that there is no correction, there is no need of conditionality. And all these measures are legitimated by the laws or treaties and justified by the principle of solidarity. And solidarity is very important, not only because it is in our treaties, but also in a pragmatic way. Not the animal spirits, but the sentiment of solidarity has stabilized our financial market during the crisis. Say that, of course, we have to stress the fact that the spectrum of an excessive public debt is still around us and around Europe, and of course, it could be a big risk for the fragile economies of some countries. And so Italy, to come to my country, so Italy is facing a great opportunity on one end and a great risk on the other. As we know, all the measures were designed to support and benefit the countries that were affected by this pandemic crisis. And Italy was the first one, and the first one that was hit by that, and the first one that was supported with a huge amount of money. So the great opportunities is to modernize our state, to relaunch our economies with the green transition and the digital transformation. On the other hand, I see the great risk of an excessive public debt in the post-recovery situation. So the key words to be successful in combining funds, reform, and investment is to enhance a policy in action that is selective, that is responsible, that is efficient in combine not only the financial instrument with long-term investment, but by absorbing technical expertise, capabilities in implementing the complex plans and projects that come from transition, that green transition and digital transformation. But it is very easy to talk about digital transformation, greening economy, but how is complex to do so, in particular in some countries like Italy, and which is the gap between the short needs of decision and the urgent needs of decision and the long term of this complexity. So one of the key is also the role of the private sector that is very, very important in supporting our economics, also to building up public-private partnership and working with this, our European important institution. To give you an example of that, we are working as a Task Force Italia on some proposal measures. For example, about the modernization of our state, Europe asked to us the reform of justice and of course to reduce the time of judgment in civil and commercial disputes. So we are passing a law and measures that are based on the criterion of specialization. So to assign to the judge few cases in a specific subject so that the judge is able to become an expert on that specific field. Another measure very important is to build up an infrastructure, technological infrastructure that cover all the national territory and that use the technology of 5G that also can be able to prevent the digital exclusion. And about the role of the private sector is important. We are working on the electrification of public transportation by using technologies that not only will allow the speed, the safety and the security of the transportation, but also that reduce the CO2 of emission. So we have to combine technological expertise and political capabilities. And I think that Mario Draghi is the person that can synthesize these two elements that are very important to us. It's not my political opinion, but it's a matter of fact that the trust of the European organization and the markets is looking at this as an important value. Thank you.
Well, thank you very much. I take it as a statement of hope for our country. My question to Mr. Singer, who is the chief economist of Generali, starts from the consideration, which I think everybody agrees on, that public resources will be insufficient to fund the building of a better Europe, but also that funds intermediated by banks, of course, we have a banker on our panel, he can expand on that, but also funds intermediated by banks will be quantitatively and qualitatively insufficient to fund the needed investment. Then the question, which is natural to ask from the chief economist of Generali, is, can insurance companies help? Can insurance companies provide long-term funding to help fill the gap left by public bodies and banks? Under which conditions would this be possible? Maybe drilling down, would securitization help in this respect?
Well, thanks. First, thanks for the invitation for this beautiful place. It's a pleasure to be here again. And second, thanks to organizers for their persistency in building the tradition of the forum, which I believe is very valuable. And let me, perhaps answering the question, return to what distinguishes this crisis from the previous one, from the Lehman crisis in terms of performance of financial system. And in Lehman crisis, a lot of taxpayers found they are supporting their financial institutions. A lot of countries found they needed, including EU countries, I will focus on EU, found that they need lifelines from other countries to keep floating. And this is not the case this time. I mean, the financial system was a buffer, not a shock multiplier. not only the private financial system, also the financial system of countries. I mean, who would imagine 15 years ago that Hungary or Poland could essentially carry out something of a mini QI quantitative easing policies with no problems for investors in their sovereign debt? This is or that Serbia is going to perform like it does in pandemic crisis. So in this respect, we have a more stable financial system, meaning we have more stable financial institutions. Let me now move on insurance industry, and here I honestly believe insurance industry didn't have a problem in Lehman crisis. There was one problem of one big insurance company called AIG, but it was a problem of its management and its supervision, not of insurance financial performance as such. Despite the fact the regulatory framework changes, and I must say that as I am ex-governor of the only supervisor of a country financial system, I had a displeasure to watch some changes. Despite that, the insurance industry ability to invest in low liquidity long-term projects was simply restricted by what happened in regulatory frameworks. And I believe that that should be changed. I honestly believe insurance industry essentially serves three social roles. First, of course, it provides liquidity to those who due to disaster or something similar have no chance to collateralize any assets because they lost all assets. Second, it pools risks in order to manage them more efficiently than they would be managed separately. And the third one is simply to serve as a source of long-term, low liquidity, reasonable return in investments. Essentially, insurance industry was always investing in projects that rewarded long-term persistence, that reward, like pieces of art, real estate, pieces of infrastructure. This was the role of insurance industry. And I believe it would be nice to return back to that. Talking about securitization, I think it just shows, first, securitization is a help. I see it in our own interest in securitized assets, being it quasi-governmental, university pieces, or real estate development, sort of this. But as a matter of fact, it's just packaging of something that is illiquid, as something that looks a little bit more liquid, being packaged as security, which allows in a current regulatory framework to invest in those with lower capital cost. Fine, but quite frankly, this is not a real solution of the problem. It's just a regulatory gap that's used. And I believe that we need a more fundamental change in approach to insurance industry framework of investments. And I believe we need it even more because, and I return to what you said at the beginning, we are in highly uncertain times. We will create, those will keep occurring because big initiatives like Green Deal effectively change the investor situation, change the calculations of costs, and let me just stress, in a short-term, highly unpredictable way. Who would, for example, imagine 2 years ago that the financials of most of steel companies would look quite nice in EU, thanks to appreciation of commodity prices, thanks to prospect of some climate import tax or however we call it. Simply, we will have a lot of uncertainties. The times will benefit those who will be persistently investing in projects of a solidity. And in this respect, insurance industry can provide help if it's going to be offered a chance, I would say bigger chance in terms of better framework for that. Let me end up here.
Well, thank you very much for giving us a sense of what the insurance company can, could, or cannot do. And our last speaker will cover another important topic, which is about banks. We would like to hear about your bank, but maybe more generally, how do you see European banks are preparing for this post-pandemic world? What are the strategic lines that banks are following, or maybe should follow, in your assessment? What can be their contribution to building this better tomorrow? And do you see complementarity or competition between banks, insurance company, or the capital market, and public institutions in funding this better tomorrow?
Thank you for your question. So before I speak about post-pandemic period, I will speak a few words about pandemic period.
So this crisis was different, I agree, than the previous one. First of all, because not all the sectors were heavily impacted. Second, lending activity of banks has remained high, so there was no stop of lending. Our loan portfolio has increased also last year 6-7%, so it was a significant increase. Second, the banks were much better prepared, mainly or partly due to the regulators, because regulators have required higher provisioning, higher capital, and there was a high liquidity on the market. We in OTP even over-fulfilled. We have provisioned higher than the market, and we always had higher capital adequacy than most of the competitors. What we did differently, also in this period, we could afford to make expansion acquisitions. For example, we negotiated in this pandemic period the purchase of Nova Kreditna Banka, and we signed it successfully this year. We just wait for the approval to close the deal. So we were cautious, but if there was a good opportunity, we have used it. What has changed and what will remain? Part of the changes will remain with us for a while. Digitalization became much faster and much more active, and of course home office activity became quite common, and most of the developments we had to do from home office or partly from home office. We even had 2 integrations, bank integrations, during the pandemic, which we finished during pandemic, and most of the bank integration was made from home office by a few hundreds of people in the headquarters and in the countries where it was made. So it was difficult, but we have learned a lot. What will remain with us, of course, digitalization and home office will remain with us. And one impact of digitalization is, and high liquidity is, which will have an impact on the banking system, that development costs are very, very high. Digitalization is not made by the banks because it's cheap, because it's I would say it's expensive, but it's demanded by the clients and makes the life of clients more convenient, and there is a strong competition in this area, and simply small banks cannot afford such high development costs. So what will come? I think more and more banks will integrate, especially on the same market. I think it has no sense if a big bank of one country and big bank of another country will integrate, because there will not much synergy from that. But on the same markets, more and more banks will be forced to integrate, and acquisitions will remain active also in the future. What is also a conclusion of the changes, that the valuations of banks have changed a lot. Let me start with our bank. our market cap went up to more than double in the last 15 months. There were banks who came down significantly, so there was a higher differentiation between the banks in this heavy period. There was also a question, at least in writing, what we can do, how we can improve the welfare of the clients, of the population. I would mention a few of them. I would mention again digitalization, that we make the life and banking and financial services and also other digital services we integrate. This is how we make the life of clients, I think, more convenient and more effective. The second, which was partly mentioned here, which became really part of banking activity, this so-called ESG. I think this word is known to most of you, environmental and social aspects. It became really reputational questions that those banks who don't keep these rules, they lose their reputation among clients, regulators, and I can emphasize, I can tell seriously that it has built in the activity of most of the banks. One still small change that real estate market has changed also a lot. Office demand has declined. There is not much activity in this area, but residential market is booming in all countries. What we observe, there's a high increase of residential lending, and this is what the banks have to serve. And still I have short time to speak about capital markets. We think that in Europe there is more a complementary activity between capital markets and commercial banking. Capital markets is mainly for big companies, and we commercial banks, we work with them, but we also concentrate more on consumer and SMEs, and work a lot with insurance companies, EBRDs. We try to generate deals and we share risk. We have a very pleasant cooperation also with EBRD and with EIB, and we sell some bonds to insurance companies. So we like to work all these institutional investors. Thank you.
Concordia is the name of the game. Everybody's pulling in the same direction. Now we have 20 minutes, and of course maybe the panelists would like to react to something that other panelists have said, or maybe there are questions from the audience. I have a battery of questions to ask from you, but I will not do it. I will first give the floor to you panelists to react, or to the audience. Would some of you like to react to something, maybe to disagree with something that has been said?
Just maybe to react, I wanted to react on the question you raised, and which is whether there is a competition between private and public banks. And from my perspective, there is clearly no competition. For a bank like EBRD, we are there only when there is market failure, when there is a need, because it makes no sense, in my view, and I think in the mandate we have, to come and compete with where the private sector can do it. So what we can bring is indeed risk sharing, or sometimes bring additional technical assistance, technical knowledge, and take part of the risk, for example, to go further in Green Deal and so forth. And in a country like Slovenia, what we've been doing is been quite active in buying bonds which were more risky, tier 2 bonds and so forth, so which were needed in order to, in the context of the banking union, to take more risk, and the market was not really there. So it was useful to fulfill the regulatory requirements in terms of balance sheet and be able to be more resolvable for a bank. Market was not there, so we helped to create the market, and on top of that, we had some commitment from the bank to invest the equivalent of our investment in green financing. So this kind of structure, I think, shows the value added, what we can bring on top of to complement the private sector. But I think competing wouldn't make no sense. Please.
Thank you. Just also to complement what what Odile mentioned. Indeed, the partnership between the multilateral, between the IFIs and commercial banks and the private sector is critical. We are not competing. We are just really supporting each other via the different risk-sharing instruments and guarantees. For example, many significant part of the investments, the funding provided by the European Investment Bank is channeled through the commercial banks, through the private banks, national promotional institutions as well, together with the private banks, because they are our let's say financing arm on the ground, knowing the business, knowing the SMEs, the companies, having the necessary infrastructure in place. So this is a very important element to mention. And something about also even securities, not only risk sharing. With the unfolding of the crisis, as part of the overall support package, it was decided that we established a European Guarantee Fund to support SMEs, to support the businesses with liquidity and funding. So we as a group split between the bank and the European Investment Fund our investments in support of SMEs to overcome and to go through the crisis. So we have this kind of risk-sharing instruments already. As of today, for 1 year, we managed to sign more than 6 billion euro of risk-sharing instruments with commercial banks and some equity, quasi-equity instruments, venture debt instruments. But our more riskier financier, our financing arm for SMEs, which is a part of our group, is the European Investment Fund, where we started with providing support for SMEs with the different instruments, but recently we have agreed also with the European Commission on asset-backed securities, also to provide as part of the instruments in support of the companies through this crisis period. So there are plenty of opportunities, and this is a joint team effort, as we have Team Europe in supporting accession or fragile countries and in the different investments. At the same time, with the private sector investments, I believe this is an excellent opportunity through the different instruments to provide, to channel the support there.
This is a safe pitch to you to buy some asset-backed securities.
Well, certainly. Let me make two comments on this. One very particular one, the second one very general. The first one, as I serve also as in the supervisory board of bigger Czech bank, and we used EBRD funds to support euro lending for SMEs willing to go to export programs. I believe, in particular, this sort of liquidity, essentially liquidity provision to allow to grow up export-based growth in some of your constituency is very valuable. So that's a very particular comment. Second, very general. Again, no matter whether the inflationary pressures are transitory or non-transitory, we are returning to the times of essentially safe positive returns. I strongly believe that. And that means the competitive pressures among financial institutions vying for projects with positive returns will simply recede, will be lower. And that simply creates more space for cooperation. Simple as that, I believe.
People would share that, but there is an increasing number of people who think that. Anything else from panelists or from the audience? Oh, please, Mr. De Luca.
Would you like just to put on the floor a question related to the digital transformation? I know that everybody talk about this kind of important and pervasive investments, but sometimes our optimism hide some risk. We know that a huge private investment from the private sector and also from sovereign fund and also big countries is flowing to Europe. So, we know that Europe has passed a law of controlling the FDI coming from non-EU countries. And in Italy, this government and the previous one has reinforced and strengthened the power, special power to control the merger on strategic infrastructure that can be in a way that you can involve our national security. So one of the solutions that is also one of the issues of the Black Strategic Forum is to strengthen the relationship between Europe and the United States, because there are other important countries that are looking at Europe as a way to control, as we know. So it's important to look at the opportunities, but also to the risk. And of course, I know the risk that to guarantee the security, we can limit the competition, and in a way we can favorize the deglobalization. That's also another risk that we are facing over this time.
From the audience, please.
Good afternoon. My question is the following: is about the big investment package which is now being launched in Europe, and the discussion we are also having about strategic autonomy of the European Union. Right now, we have many governments launching public procurement operations for digitalization, as an example. The question is, who will benefit from these big public procurement operations? European companies, American companies, or other companies? And what can we do about this? So investment and strategic autonomy, this is my question.
To take that one. You want? Please.
Honestly, the simple, safe answer is lawyers. Lawyers would benefit. And if you want also the countries to benefit, I believe the world digital landscape in digital product, essentially, that's a pity for Europe, but essentially has only two big mass market able to draw on big data, and this is China and US. And the strategy for Europe is simply to allow as much of competition as possible, with, of course, due respect to security and all other context of the things, because we are unlikely to create, given the language split, given the consumer protection split, given the split of legislation, we are unlikely simply to provide a big data market for digital products of 270 or million people. Yeah, that's very difficult to do.
And cannot change the programmable language, but maybe consumer protection, maybe some other aspects can be, because it puts us, in a objectively weak position towards the US and China on a critical aspect.
Fair enough, but I do not believe we can change that in a few years.
Klaus?
Maybe I can add. Of course, we always need lawyers, but there's still the strategic question what to do. We do have a common procurement framework in the European Union. There are minimum rules, so small projects don't fall under that, but all the major projects. And now there's a debate to create exemptions, to deviate from that when bids come from countries, and this is mainly China, but not only China, where we know that companies that participate in a procurement exercise, they make bids that are much lower because they are subsidized at home. They are state-owned companies, or they are subsidized by their governments. And the European Commission is right now in that process of amending the European procurement framework, which has existed for some time, to take that into account. It's not easy. It also can mean that certain projects become more expensive than in the past. So one should have no illusion here that it's not only positive, but it's probably unavoidable given the experience we have had in recent years.
Mrs. Pavlova?
Thank you. I just wanted also to complement with a little bit maybe different angle on the top of the. As we speak about European economy, we have to be really very, how to say, careful about what we do about creating the much needed innovation ecosystem in Europe, because this is what is missing. Our competitors are there, so really investing in creating and supporting these innovative startups, innovations in Europe, and keeping them in Europe, because they easily fly just to US or to Asia. So this is another important element, along with the investments needed in not only in transforming our economy, but industrialization, digitalization of our economy, in order to ensure this independence from supplies which we are faced during the pandemic. So this is one important element, along with the others, and that's why with the European Innovation Fund, which was established, where of course EIB is playing a role there. This is something which urges us at Europe to be faster, to invest in more riskier operations, to react fast, and to make sure that we support companies and their transformation. And maybe as a conclusion, because we started with uncertainties and inequalities, whatever we do for economic recovery, for and the twin challenge with the climate crisis we are facing, ensuring just and fair transition is indeed is a critical element, because certain industries will have to be closed, and we have to admit it. Others will have to be adapted or changed. And not all regions, not all businesses are starting from the same level, and inequality is there. So ensuring the different elements of just transition and supporting is critical. That's why the Just Transition Fund and the mechanism which is there is an important element, because climate funding and adaptation and cohesion, they should go hand in hand. They should not compete, because we have less developed regions, like many regions in the newly acceded member states, for example, in Europe, and where they were suffering a lot even before the crisis from being having less developed regions, carbon-intensive regions. So we need to pay special attention and to have special focus of our investments there. And that's why through the three pillars of the Just Transition mechanism, this is a way to overcome and to support the minimizing these inequalities, and supporting less developed regions, supporting through the first pillar governments in their investments for the transition of the economies, providing support for InvestEU, and the second pillar for the private sector and the private companies to invest via the necessary guarantees, and also local authorities, because local authorities, municipalities, they are on the front line of the challenge with society, with vulnerable groups and companies, and also providing support there is critical. And we have special instrument, public loan facility, supported also by grants, and the loans by EIB in order to help municipalities. So these are the different dimensions which we have to look together. That's why I started that we need to plan wisely, and to take into consideration all different elements and financial sources in order to have this the stable long-term vision of our recovery. Thank you.
Yes, thank you very much again. And let me specify my these, which I gave before about competition of Europe. And I think that we have to know that competitiveness, it also, if we are comparing with other continents and Asia countries and other countries, is one of the most important value, or one of the important element. And I think that one thing we need, let's say, a strategic objective about that. And to have a strategic objective, it means that to be the industry, the economy, let's say, more competitive than others, or let's say, maybe equal competitive than others. But we have to look at this very carefully, and first of all, we've got some data, we've got some information about that, how much Europe invests in research and development, and how much Asia or China or US invest in research and development, or how much new patents has Europe, or patents. We can also do this and compare this, and then we can see how much we should invest in, let's say, innovative products and also inventions, etc., etc. And I think that I don't have the data myself, but I think that we have to invest more if we look at this data. And only on long term, I think that these investments also improve our competitiveness. And of course, we need strong economy in Europe. We need competitive economy in Europe and financial robust economy compared with other continents and other states. So I think that this is very important, and also I think that we have to develop new products, new services, etc., etc. But let me mention also, on the other hand, that we have to also change some things, or to have invest in human resources, to have invest in, let's say, health system. I don't know if in all countries, but also in some of them, I'm sure that we have to do. And also with what we have to look is to look at our demographic problems in Europe, and to be prepared, because as I know, these demographic problems exist. It means that population will be older and older, and that also pension system will be, let's say, broader and broader, and also they use more money as now, and we have to be prepared in long term also in this element. Also to secure competitive economy, and I think that recovery and resilience facility is one of the elements with which we started, and I think that we have to look the element of efficiency, and we have to also control. We have to have control elements in this facility, and I think that we are in good path to be more efficient and also to be more competitive.
Well, in my previous environment, central banking, ending a meeting with 1 minute and 20 seconds delay was considered sloppy. However, I hope you will forgive me for not having ended this just at 4:30, but I would like to thank the panelists, I would like to thank the audience, and I would join the thanks that came from all the panelists to the organizers of these impressive meetings. So thank you very much, and we hope that what we said didn't resolve the uncertainty, but will help you navigate the uncertainty. Thank you very much.